Let's bring in CNBC contributor Stephanie Link of Hightower into the conversation. Steph, it's great to add you. So what's your big takeaway then from the way that this week has started and this year has started?
That the economic data is supporting the soft landing that all of us are talking about. I always worry that when we're all talking about the same thing, but you got to look at the numbers, Scott, and it's not just the job report today. I mean, look at ADP, look at Challenger Gray, look at initial claims, which is a leading indicator. That's at 207,000 four-week moving average, so far from a recession. But then I also look at durable goods, and I looked at factory orders, and those numbers came in better than expected, with business spending intentions going higher. So there are parts of the manufacturing part of the economy that are seeing a pickup because of the onshoring, the reshoring, all the infrastructure bills that have been put in place. So you kind of add it all up. The growth is there. Obviously, we all want to see the inflation numbers come down so that the Fed can cut, but it's not. It's still at 4.1%. It's still okay, but it's elevated. So that's why I don't think the Fed is going to cut 6 times this year. And if, by the way, they do, that means we have a massive decline and a turnaround to the downside in the economy. And I just don't see it at this moment in time. So the 3 takeaways, I think fewer cuts, I think better earnings, and I think the consumer has actually been really strong. And I'm really encouraged by Costco. And I know Costco is a beast in itself, but you had a 100 basis point acceleration, x the 1 extra day that they had this month from the first quarter, 100 basis points acceleration. And you had a 400 basis point acceleration in non-food purchases. That's discretionary. So my thinking is maybe services is coming down a little bit from the torrid pace that we've seen, but maybe that we've seen the bottom in the goods side of the economy and the goods buying in the economy. So let's keep an eye on it, but I'm pretty encouraged.
You start to worry at what point that the strong numbers that you always cite as a point of strength in the market story undercuts the cuts, and then the market has to reprice itself.
Well, I think that's what we're dealing with this week. I think 6 cuts got way ahead of themselves. I definitely do not think they're going in March. I think maybe they do 3. We'll have to see. I mean, we're all data dependent, including the Fed. So CPI number next week is huge, and PPI is pretty big as well. And then earnings, we'll listen to what the companies have to say and how they're dealing with all of these moving parts. But I do think whether the Fed cuts 3, 4, 5, 1, or 2, earnings are going to come in better than expected because demand is actually better than expected. And I really feel very strongly that the margin side is going to stay strong, especially because wages are coming down, input costs are coming down, supply chains are getting fixed.
You agree with that comment, Courtney, that earnings are going to come in better than expected that Steph just made?
I do, actually. And I think the idea that this earnings recession is ending and we're only going to see improvements from here, I think is really what we're looking forward to. I think she makes a really good point that the consumer is strong right now, right? Ultimately, we are a consumer-driven economy. And even if wages do start to come down, people are starting to spend into their savings that they've really built up during COVID. So maybe we do start to see a little bit of a slowdown. But as long as we have a tight labor market, people do have the means to spend, and we have a very confident consumer, and that likely is going to lead its way right into earnings.